Markets end the six-day winning streak as investors book profits ahead of RBI monetary policy outcomes. Sensex gyrated 1,136 points during the day before settling at 58,299, down 52 points. Nifty also ending on a flat note, down 6 points at close, however holding on to 17,300. Financial stocks dragged, headline indices lower. On the other hand, IT and pharma shares lent some support. NTPC and Tata Consumer some of the top laggards, followed by Coal India, Shree Cement, SBI too under pressure ahead of quarterly earnings. On the other hand, Cipla, Nestle, Sun Pharma, Infosys and Apollo Hospitals some of the top blue chip gainers. Meanwhile, the rupee continued to weaken sharply for a second day in a row. The Indian currency plunged to 79.45 as the greenback strengthened after Fed policymakers suggested more rate hikes are yet to come. With the rupee in volatile territory and inflation soaring, all eyes are now on the RBI's next move. Central Bank's Monetary Policy Committee has been in a huddle for 2 days now, and the outcome of the meet is expected tomorrow. The RBI is likely to hike interest rates by 50 basis points, and repo rate is all set to be back at pre-COVID levels. What will the central bank's next move be to arrest the rupee's fall? My colleague Sakshi Basra joining us on what's expected tomorrow and how an interest rate hike will impact our investments and loans. Sakshi?
Well, loan borrowers may need to brace up for higher interest rates as the RBI may be all set to raise the interest rates yet again. In less than 12 hours from now, the RBI governor will announce decisions of the policy review by the Monetary Policy Committee. The two big concerns the RBI is expected to address this time around is high inflation and also global recession. To tackle the first concern, the RBI has already been using its Brahmastra, hiking of the repo rate. Now, first by 40 basis points, it was done in May, then also 50 basis points rate hike was done in June, after which the repo rate was raised to 4.9%. Now the RBI has a tough task of keeping the CPI inflation within the 6% range, but lately, despite all its best efforts, inflation has remained defiant and above the tolerance band for over 6 months now. Now there is a wide expectation that the RBI may again hike the repo rate for the third consecutive time in this current policy. Now this could be in the range of 25 to 50 basis points. The existing rate of 4.9%, however, is still below the pre-COVID level of 5.15%, and most experts do believe that it could be raised to pre-COVID levels yet again. Now our Business Today poll on social media had the maximum votes for 35 and 50 basis points of a rate hike. The stance of the policy this time is expected to remain unchanged at withdrawal of accommodation. Next, one will also watch out for inflation and the growth forecast by the RBI, and whether there will be any tweaks to the earlier predictions that the RBI has already made. Now, most experts believe that commodity prices easing internationally could actually point at inflation risks receding from now on, and therefore the RBI may actually keep the inflation forecast unchanged at 6.7%, and on growth forecast also one will watch out for the RBI commentary for any dark clouds looming large due to the US coming into technical recession. And new and emerging geopolitical tensions and risk between US and China also emerging now. However, most experts believe the RBI may keep the growth forecast also unchanged at 7.2%. Now, the rupee depreciation is another major concern. It has hit a historic low and has gone past the 80 per dollar mark. Now, there are some pullback kind of indications that we are already getting, but the RBI's comment on it will be very important to watch. Now, the markets will also seek assurances from the RBI on whether there is ample liquidity in the system. The central bank has said, time and again that it is going to be taking any measures if needed to curb any kind of tightness in liquidity if at all needed. However, for the common man, what will be essential is that any rate hike done by the RBI this time around will definitely impact the loans and make the EMIs expensive. So home loans will immediately get impacted because the banks and NBFCs will in turn raise those rates for you, the lending rates in example. And any kind of new personal loans or new auto loans will also get some impact. On the other hand, if there is some cheer, depositors could definitely hope to cheer on the higher interest rates on deposits like the FDs as well.